Welcome to Growth and Exit Strategies for Software and IT Companies, the flagship tech conference of the World Financial Symposiums. The GXS conference caters to tech founders and investors in tech M&A, covering topics like investments, growth strategies, buyouts, sales, divestitures, and mergers. Thank you for joining us. Let's begin.
Okay, welcome back. Thanks for hanging in there with us. I think this first half was really insightful. We learned a lot of, I think, exciting information on the trends that we're seeing. And, we started with kind of this global perspective, and now we're kind of drilling down into layers of Latin America specifically. And this next section, I think, is going to be equally informative. Excited to welcome Javier Tané, who's our Senior Vice President from Europe here at Quorum Group, actually out of France. And so I'll let him introduce himself. He's going to introduce a panel of buyers who are active in the Latin American market. And they're going to share kind of what their key acquisition criteria is, profiles they're looking for, and some of the kind of minimum deliverables that you could anticipate that these buyers are looking for. So Javier, turn it over to you and this illustrious panel.
Well, thank you very much, everyone. Thank you for joining us. It's my pleasure to be here with you. My name is Javier Tané. I'm a deal maker with Quorum, Senior Vice President, joined the firm 8 years ago. I'm actually based in Europe, in Paris, but that did not stop me from helping one of our clients a year ago, and that client actually, by the way, was acquired by Alberto here present. It is my pleasure to be here with you, and I also have the pleasure to have Alberto, Bruno, and Sindre joining us. There are three buyers working for large organizations, and these are all over the world, by the way. And let me start with the introductions, and let me start with ask Alberto to do his introduction. Alberto, please.
Javier, Bruno, and Sindre, good afternoon, good evening to all. I am Executive Vice President at Evertech Group. Evertech is a company that actually has operations in Latin America, covering 26 countries with actually offices in 13. Okay, key sectors where the company currently operates are payments, financial services and software, and MSP. Okay, but particularly the first two as the most relevant ones. Prior to joining Evertech 3 years ago, I started my career as a management consultant at McKinsey, then did investment banking for 19 years, 14 of them at Morgan Stanley as a managing director, and then Itaú. And then I was CFO of publicly listed online travel agent Despegar, that is broadly known in Latin America. So pleasure to be with you all this afternoon.
Thank you very much, Alberto. Bruno, I'm following the alphabetic order actually here.
Thank you, Javier. Nice to see you guys. It's a pleasure to be here with Alberto, with Sindre, wonderful companies. So I'm Bruno Caloi, currently running the corporate development and M&A initiatives for Stefanini Group. So Stefanini is IT services or tech consultancy, born here in Brazil, in São Paulo, where I am now. But today we are very proud to say that we are a global company competing with those giants, and we are present in 46 countries, delivering for more than 100 countries from them. So my career, I started in Natura. It's one of the major beauty and cosmetic company here in Brazil, with operations in LATAM, with investor relation office. Then I went to a real estate company owned by Pátria Investimentos, the private equity large private equity here in Brazil also, and I'm here running the corporate development for Stefanini for 5 years, where we have been having exciting times doing 4 or 5 acquisitions per year. 1 in Brazil, 2 in Brazil. We try to split between Brazil and worldwide, and happy to discuss one of them here with you. Thank you.
Thank you very much, Bruno. Sindre.
Yes, thank you, Jabber, and great to meet both you, Alberto, and Bruno. It's a pleasure to be here. So yeah, my name is Sindre Holland, Chief M&A Officer here at Visma. For those of you who are not acquainted to Visma, we are one of the largest, call it ERP, cloud accounting, payroll, invoicing, tax for SMEs, typically. One of the larger ones globally. We're also quite acquisitive. So we do typically between 30 and 40 acquisitions per year, mainly across Europe, but also now in the more recent years, we've also done quite a bit in LATAM, which has been a very positive thing for us. And the reality, yeah, I mean, I've been on a personal note as well. I've been with this firm now for 17 years, so it's been a while. Probably been involved with 400 plus acquisitions. I guess you sort of lose count at one point. But yeah, it's very, very high level.
Thank you. Thank you, Sindre. And thank you, everyone, for your introduction. In the audience, we probably have a majority of sellers, and you guys are on the other side of the fence, actually. Your expertise and insight on what happens on the other side of the fence is very valuable for me, actually, because I'm mostly working with sellers, but also and especially for our audience. I would like to start with a question of, when you're looking at the company, what fundamental characteristics do you see or that signal for you that the firm, the business, is the right target for you? And this is probably going to be very specific to all of you, but I think we have a very diversified expertise here coming from different sectors. So maybe we can start again with Alberto on the main fundamental characteristics that you're looking at.
Certainly, we can start with 3 key variables, I would say. The first one being, okay, that it strategically fits with our different verticals, okay, not only from a perspective of like the strategy, but also how the company operates, and so that we will be able to add value to the company and integrate to the extent that integration makes sense. Okay, so the operating model is something that we certainly look at beyond just what the sector or the strategy that the company has. That would be the first thing. Second is understanding the rationale for the sale process. Okay, why really the founding team or the senior management or the investors are actually looking to exit. Okay, we pay a lot of attention to that. Okay, and it could well be that doesn't necessarily equate to the size of the company, because things like that are very, let's say, company specific. For example, the age of the founders could make sense or not, etc. We very much try to understand, okay, the team that we will be receiving, and hopefully we will be nurturing that team. Okay, makes sense to keep on working with us. Okay, so if not, that would be a completely deal breaker. Okay, and last but not least, scalability and transferability. What do we mean by this? Transferability across countries, okay, that the business can actually move from between borders. Of course, you always need to tropicalize the business, okay, for a regulatory standpoint, etc. Particularly, that's very relevant in payments, on financial services software, okay. But that transferability is relevant as we operate in several countries in the region, and scalability, okay, that the cost to serve, the additional transaction is really the marginal cost to serve is close to zero. Okay, so that there's not a lot of, let's say, manpower required for that to take place. I would say that those three characteristics are things that we certainly look into.
Thank you very much, Alberto. I like the fact that you mentioned the team first and the importance of the people before you mentioned the scalability and the operating part of the business. Actually, that I found very interesting. Bruno, maybe you can share with us.
Sure. So trying to complement what Alberto said, for us, it's the base of clients, right? It's very important because it's the test, the proof test, right? For these companies. We don't do rounds here. We don't do VC. So we are not looking for guys who have ideas to change the world, basically. So we are just looking for companies, profitable companies. We don't have a high growth thesis, right? So we look. So in this approach, it's very important to see the base of client. Then I will split in two totally different approaches here, because we have a software company, product company, IP, proprietary technology company. What is Topaz? It's a core banking system, online fraud detection. It's a software company. And we have also Stefanini, the core business that is the IT service and technology consultant. So two very different words, right? And for product companies, I would say that the technology, the scale, the ability to scale, to move from one country to another, as Alberto said, is very important. The famous TAM, total addressable market, is also very important because sometimes you see very good technologies, but with limited growth, limited market. The performance of the software, of course, we test a lot in the due diligence, the performance, because we are a high performance company in terms of software. Then in the other side, when you see a service business, and here the team is very important, the management is very important, but it's not tier one in terms of if I can compare the performance, and then the team in a software companies is different. The weight that we evaluate against a service company. And then in services, what we are looking for, and again, as Alberto said, we are not looking to buy volume or people or contracts, right? We are always seeking to acquire capabilities, new capabilities for the group, right? We have the core business of the company. It's always cheaper to grow organically, right? In software development, in IT, in SAP, maintenance, and all this stuff is always easier to grow organically. So an acquisition, it's something very, very expensive, right? So we are always looking to see the capabilities of the company, right? So the service, the capabilities, also the certifications, right? So all the vendors, they have a lot of certifications to operate, to implement, to give the applications development to their stack. So if I can, in a nutshell, performance, team, capabilities, and different words from service and software companies.
Thank you very much, Bruno. Sindre.
Yeah, I think a lot has been said already, right? But to try to contextualize it a little bit, I think first and foremost, right, when we look at companies, I think it really needs to fit the equity story, number one, right? If it doesn't, then there is no point, right? So I really think for us, we're essentially a serial acquirer doing this sort of amount of acquisitions, and it really needs to fit that story, right? Cloud accounting, invoicing, tax, payroll, sort of in that ecosystem, it really needs to tick that box. So that's sort of, you have to start there. And then I believe we've touched upon a lot of the right things and essentially what we're looking at as well, right? I think we're buying software companies. So needless to say, tech and product, that's key, right? And with tech, as Bruno, I think you've talked a lot around sort of scalability and these type of things. I would actually add security as well, also fairly important. So sort of to have a good tech stack, modern, sort of up to date on language, etc. I think that is important, as well as actually have a product that customers like, right? To have good customer satisfaction. So I actually do believe that is quite important. Then I would also say the team, as I think both of you have already mentioned before. I think that is important, right? Needless to say, if you do 30 plus acquisitions per year, you know, from a Visma standpoint, we don't come in and fix things. We don't do turnarounds. We buy well-run companies that are already proven, where there are already happy customers, where there are already sort of high growth. That's the type of companies that we like. So sort of that needs to be in place, but it needs to be in place together with the strong management team. So we don't come in and fix, as I said, right? There needs to be a prerequisite is actually to have that team, unless we think about it as a product acquisition, right? Then we can have a different view on it. But if this is a platform to continue to build on, I think, needless to say, that team, super vital. And that's also why we typically have earn-out agreements or sort of staged acquisitions, because we want that team to be very, very incentivized to continue to run very fast, also in the future. And I think that's also, if you look at all acquisitions we've done, 70% of all founders, they're still on board 5 years after we've acquired them. And I think that tells you a lot also about how we go about this. So that is very, very important to us. And then I think, yeah, I've touched upon, right? But financials as well, just sort of needs to be in place. They need to stack up. Like Bruno said, we're not a VC company either. We like things that grow very fast. Definitely we do. But we also like things that are very proven. So yeah, I hope that summarized it.
It does. Thank you. Thank you very much, Sindre. I would like to move on to the process, to the M&A process, and check what would be one example of advice you would give to a seller preparing for a potential for an M&A process. And from your examples, from your experience, is there anything that you would like to emphasize more, a specific advice? Let's move on, switch a little bit, because Sindre has always been the third one to answer. So let's now start with Sindre, if you want, and then we move the other way, actually.
Yeah. So yeah, of course, I'm usually a buyer and not a seller. But
my question is, from your point of view of the buyer, when you see things in front of you, how would you advise a seller to optimize their process in order to be a success, from both sides?
Yeah, exactly. So I think, you know, when you've done 400 plus acquisitions, needless to say, you've done probably quite a few more BDs. I think it's fair to say that you've probably seen it all, but still, you never get surprised, right? So I think a couple of things. Preparation. Like if I'm really want to pinpoint one thing, it's to prep for a process, right? Because it's a big task, and you will need to prep for it. Whether that sort of one thing is a data room, like that's fairly simple to just gather that. but to actually have sort of be on top of all your numbers, be on top of the unit economics, be on top of your equity story. I think these things, they just need to be there, right? It's not something we expect you to be doubtful of. So I think sort of prep, that's vital. And then it's also, to me, what I always find fascinating sometimes is if there are any sort of big elements, either it's you don't own your IP or your biggest customer have terminated the contract, whatever it is, right? It can be many things, but in general, sort of big things impacting the company heavily. And I've seen so many bad attempts on trying to hide these things and come up with it in the 12th hour, these type of things. So I would always say sort of try to come clean with that as soon as possible, if there is anything. Right? So to come after 7-8 weeks of DD and tell that you actually don't own the IP, that doesn't, and speaking a little bit from particularly LATAM, right? I'm based out of Oslo, Norway. I think we are fairly transactional in this country. But in LATAM, trust is key. And the more south you go, even in Europe, trust is even more key. So for people to hide stuff, that damaged the trust so bad that it's probably broken.
Yeah, trust is something you cannot rebuild. Actually, you're right. You're absolutely right. You can only use it once.
Yes, you can do many metaphors on that, but I completely agree. It's so to continue to have that. I think that is very important. So be transparent, and then as well as we talk about, right, with the potential candidates that we plan to acquire. I think we're also very transparent on the Visma side. We're sort of a no BS company. We like to tell it like it is, how it will be, and then we also hope that the potential sellers actually come and tell us if there are any issues or how they think things will be, etc. Because if those things don't align from the start, then the deal is doomed to fail. So I think that transparency and that open dialogue, I think that is actually pretty key. So that's something I would prefer as well.
Thank you very much, Sindre. Bruno.
Good. Okay, I'll try to go in the other way to highlight some mistakes that are common mistakes. So the first one is we used to acquire companies from 20 to 100 million dollars. What is a SMB, let's say, depending on the country. But what is very common for me, it's some amazing companies of 20 or 25 million dollars. And when you see the beautiful teaser, the beautiful material, you see that the company does a lot of things, right? So they do cloud, they do cybersecurity, they have their own products, they do a lot of things. But it's very important for us. Imagine that we receive, I don't know, I brought the number here to bring you out. It's 300 teasers per year, right? So it's more than one per business day. So it's important at the first glance, at the first look, we have to know the DNA of the company, the core of the company, right? Because sometimes an amazing business of $12 million with a description of 20 capabilities, it's difficult to have cybersecurity, cloud, payments, core banking, a lot of things in $12 million, right? So you are doing one thing, you have one, probably you are good in one thing or two. So try to focus in the core, in the DNA. Do not try to open because they do this, of course, to open the potential buyers, the funnel, right? And then you have 100 NDA signs, and then it's very difficult to move forward. So try to focus, try to have this strategic conversation with your bank, with your advisory to focus in count the attention in the first 10 seconds, because a company with less than $100 million in revenues cannot do 20 or 25 services or products. So the main idea is this to focus in the main DNA, let's say. What is another mistakes that we found that creeps me out as well? The one is when it's the wrong time to launch a process after you win a big deal, right? Sometimes the founder thinks, I want to sell my company. Then when they just won a big deal, they launch the process, and you see those beautiful graphs always growing, and this year is an outlier, right? So the buyer will probably not disconsider, but will not evaluate properly this big deal that you just have won. It's not something not sustainable. And of course, in IT, you have always the beginning of the services, the implementation, everything that you know that after that is not something very recurrent, so it's a common mistake. And finally, the last one is, especially in IT services, okay? Sometimes the bankers use those tables saying that the founder has a relationship of 20 years with the CIO. Forget about this, because once the founder gone, I will have to manage, and probably the relationship is not something that we will keep the same level. So it's important, of course, to know that the company has the conversation with the senior management of their clients as a consultancy, as a consultant approach. But sometimes I think they highlight a lot the relationship between people, what is in a B2B market in Latin America and in the other countries as well. Sometimes could change the things after the acquisition. So this would be my advice.
Thank you very much, Bruno. Alberto.
Yeah, just would like to complement all the good ideas. The first one is understanding that a seller actually needs a buyer to create the value, to capture the value that has been created, okay? But the founder have already created that value, but needs someone to be able to pay for it. So I think it's really important to understand that at the end of the day, okay, the potential buyers will be spending time with the company. So the easier you make the buyer their life, people will have a lot more, let's say, inclination to push for a high evaluation, to defend it on the investment committee, etc. So that means that equates to openness. Okay, be open. Okay, because at the end of the day, trust is built throughout the process. From the very first call until the very end, you're building trust. Okay, so from that perspective, okay, looking the story as a whole, okay, understanding, okay, why the timing makes sense today, okay, that it could be a similar stage of a company, depending the age of the founders, as I said before, depending on regulatory approval that they have obtained or not, etc., okay, that means a good timing for a certain player, and they can articulate why the timing makes sense, vis-a-vis another situation that could be the opposite. So looking at the story as a whole is why the timing, okay, bankers, if they get advice, I believe the sell side process, okay, bankers do help founders and management team getting organized, and particularly they need, from my perspective, the more time they spend looking at the information very much from the outside, why there's a certain jump in this in the company's history, looking at the information and trying to come up with potential Q&A, I think that is very well invested time from my perspective. Okay, so at the end of the day, okay, you articulate the story well. Okay, again, with the idea of like being open and building that trust throughout the process. Okay, at the end of the day, when you think about the story, is how the company was founded, how the company evolved, at the stage the company is, okay, trying to avoid what Bruno mentioned. Okay, now we get a great contract, we're gonna get an incredible growth in the next 2 years, and then what happens next? So people will look at a broader history of the company and actually try to project, okay, based on the company's capabilities, differentiating factors, etc. Okay, but that exercise, from my perspective, should be done by the company, the sellers, and their advisors. Okay, look at the story as a whole. Another thing is immediate performance. Okay, we have looked at many deals in which, for argument's sake, like 2024 was a great year, 2025 first half was great. Okay, we were actually looking at the numbers to close in end of 25, and the last 2 quarters were a disaster. Okay, so the immediate performance is very, very important, okay, to be paid close attention to. Okay, so at the end of the day, okay, you keep track of the results, and actually that helps build trust and help build confidence on the asset. And last, particularly in Latin America, have a clean P&L. Okay, if you're coming with a laundry list of adjustments to the P&L, I would rather not have the company and management buyers doing it, but actually the sellers being very transparent. Again, going back to the concept of trust, okay, trying to explain that you can have like 50% of your of the headcount just as contractors. Okay, like certainly those are things. Okay, that's just one example. Okay, so if you need to put the house in order, would rather do it before the process than trying to argue that, particularly for companies that are very large, either private or publicly owned, but large corporations, okay, you cannot have a distinct P&L for the new asset you're going to acquire. Okay, they all look alike.
Thank you very much. Actually, there are a lot of parallel ideas here, and all of you have put a lot of emphasis on trust. The 3 of you, by the way. Bruno also added the fact that you have to focus on your business, actually, which is very interesting. And knowing that you come from different backgrounds, actually, in terms of the background of your companies. I would like to touch upon now another subject, which I'm 100% sure is something very important for most of our audience, actually, which is valuations. How when you look at the business, how do you approach the valuation, and if you can give some specific ideas actually on how you approach it, what is your methods or multiples that you use. Let's go start now with Bruno, actually. So
Sure. Okay. No, I was remembering when Alberto said about the adjusted EBITDA. There's a famous phrase of Charles Munger, right? That adjusted EBITDA is nice, but we need cash flow for feed ourselves, something like this. So, yeah, it's very interesting. So, the valuation is something that we do at the NBO, at the non-binding offer process. What is the final of the first stage of a process? In tech, we use a lot the multiples, right? Although this comparison sometimes make the sellers a little bit out of track in terms of companies, what are the peers, and of course, I will defend myself here, my position, but it's always difficult to compare with listed companies, because listed companies, they have a lot of clients, and the risk is very different. So be careful when when you compare with listed companies. Be careful with when you compare with transactions that you think the valuation could be this one, but the real number was not like this. So just some comments. And of course, we do the discounted cash flow, the famous discounted cash flow, although in tech, even nowadays, each time harder to predict the revenues, right, in the next year, in the next semester. But of course, we do those two methodologies, the multiples and the discounted cash flow.
Thank you. Thank you very much, Bruno. Sindre.
Yes. No, I think that's it's a good summary. I think I mean, we buy software companies, right? So needless to say, sort of looking at what we call rule of 40 is fairly important for us. And just for the audience as well, I guess, to give that a little bit more color, it's essentially growth rate plus EBITDA, or actually what we say in software, cash EBITDA, which is also a nuance, but it's something that's closer, hopefully closer to cash flow than just EBITDA. So in software, for instance, you can capitalize R&D, right? But still, for us, that's a PEX item and not something you put on the balance sheet. So to add those two together, that is important, because that tells you a lot about sort of how this company is trading and where is the focus, right? Because you can easily have 0% margin, but growing 40 or 50%, then that's still fairly good. Or say you have a 20-20 mix or whatever, right? So to look at that balance, I think, needless to say, if you're selling your software business, you should really think about how to go about that. So that's very important to us, right? I think in general, I think there are a couple of elements, right? Also, when evaluating software businesses, you need to look at sort of unit economics. You need to look at the relevant SaaS KPIs. If they don't stack up, I think you're at a pretty bad place anyways, right? And then you talk about customer acquisition costs, lifetime value, these type of things, right? So to get those KPIs and to have decent KPIs, net retention rates, etc., right? So to have those in place, I think that is important, right? That needs to be there. And then when we get that, I think then we're back to sort of what Bruno brought up, right? Then we also start to look at the multiples and think about, to be honest, we don't necessarily, I mean, we can look at the stock exchange and see what's happening with software right now, right? It's, I think we don't necessarily look too much at that. I mean, we're in software for decades and not months. So for us, I think what's good when you've done 400 plus acquisitions is that you have a library, and to have that relative valuation thinking when entering a price negotiation, that's of course very vital, right? So to think about, okay, so company X, Y, and Z that are actually fairly similar to these type of businesses, well, that was valued at X times ARR or Y times cash EBITDA. And then that's sort of how you go about it. And then you sort of triangulate that and figure out where you believe a fair outcome is. And I think for us as well, I think it's a capital allocation thing, right? We're mainly in LATAM and Europe, but for us as well, like Bruno, I heard you said 300. I think, to be honest, I think the amount of teasers in my inbox, it's an absurd amount. So it's left, right, and center. And for us, right, it's also a capital allocation game, right? What can I get? Where do I get most bang for the buck, essentially? And that we always think about as well. So to add sort of an additional layer on top. That is, of course, not the seller's prerogative. That's our prerogative. but still it might explain our behavior sometimes. But I think sort of high level multiples, right? That's how we look at it. ARR, cash EBITDA. Yeah.
Thank you very much, Sindre. Alberto.
Yeah, certainly to complement, I think that overall I certainly agree with all the traditional valuation metrics. Would like to highlight what Bruno stated on, okay, let's all be careful or cautious when thinking about like public traded multiples, okay, and things that are in the news, etc. Because at the end of the day, a multiple conceptually is has two big factors in it, okay? The growth of the financial metrics and the risk of the financial metric, correct? Okay, so you certainly need to look at both things. The fact that a certain asset is in the same sector as another, let's say, flamboyant company in the capital market doesn't mean that it will actually demand the same valuation multiple. Second, we are very intrinsic focused, meaning that we very much look at rule of 40 in the way Sindre has defined it, okay? And we very much look at IRR, and the IRR expectation differs based on the stage the company's in, okay? Although we do very little, let's say, investments in, let's say, high growth or emerging companies, emerging technologies, although we have done some, okay? Again, the smaller and the less tested the idea of the venture is, okay, the higher the internal rate of return expectation would be. Then another key thing that this is maybe complementary to what Sindre and Bruno have stated is we look at profitable operations. Okay, so then going back to the initial question about timing, okay, what's the right timing, okay? If the founders, the management team of a company are expecting to turn profitable soon, okay, the best advice would be show how the company went from red numbers to black numbers, okay? The minute you are able to present like a full audited financial statement or fully closed historical year in the black, with the company went from a material negative EBITDA margin, for argument's sake, or negative cash flow, okay, to positive numbers, that provides trust, that provides credibility, okay? Because now the question you're going to get is, okay, why don't you wait? Okay, are you in such a hurry, okay, to exit the investment today, when in reality, like, that goes hand in hand with valuation, okay? Last but not least, we're certainly not a revenue multiple type buyer, okay? Like we look at cash flows, we look at intrinsic value, etc. Okay, and we on our own projection, we're not the guys that would like to on our own assumption start believing on that hockey stick, okay? Like we certainly will not do that for the seller. So again, that goes with timing, okay, with the perspective or like when do you think the company is ripe for a deal.
Excellent. Thank you very much. Actually, it's very interesting to see that we're all using the same parameters, but each one of you has described them differently, actually putting emphasis in one or the other one. So thank you very much. Actually, we're reaching out to the last question, and but please, if you have anything that you would like to bring forward, don't hesitate to do it. Actually, it doesn't. We can allocate a little bit more time for that. If there's any subject that I haven't touched upon and that you would like to bring, you can do that now. You can also do that after my next subject, which the next subject I have is that how does life after the acquisition look like in your organization? Suppose when you have closed the deal, signed and closed, you celebrated the deal, and how does it look like in the first 6 months, 3 months, a year, and after that? So that's the last subject I would like to address here. And again, if there's anything related to valuation, to due diligence, to and advice that you would like to share with our audience, please feel free to volunteer it, actually.
Okay, I can start. Jaber, first thing is I want to comment is that we don't celebrate as a buyer, right? Because when you acquire a company or an asset or an apartment, the only certain that you have, what is the only certain that you have? That you paid more than somebody, right? So you have to, after the acquisition, just it starts your journey and the valuation you've seen 5 years, 10 years, if it was worthwhile. So in terms of integration, we are doing a very huge restructure here in Stefanini with the M&A, corporate legal, and marketing, because we used to acquire, we acquired 38 companies since 2010. And all these companies, as I said, niched companies, different capabilities outside of the software development and ITO, IT services, and we kept the founders and we kept the brand, right? So when you see the brand Stefanini, it's not as well recognizable as we desire to do it, because we split the capabilities in a lot of brands. Of course, there was a reason we would like to have our smart manufacturing company focused only in robotics, in smart manufacturing, recognized with that brand and not through Stefanini. But now we are doing like a profound change in this mindset, right? We discussed it a lot in the board, and the board decided to do like a rebrand, bring all the founders, bring all the brands, their brands to Stefanini with some capability. You can see here Stefanini Technology is the core business, but you will see now in the media Stefanini Smart Manufacturing, Stefanini Marketing. We have a digital marketing agents, for example. So we are doing, and of course the M&A team has always to be involved in these discussions. First, because the founders will say, look, but this was not the deal, this was not what Bruno promised me, and so I would like to keep the brand and keep that, so on and so forth. So it's always something that we have to work together with legal, with marketing, with operations, and we are doing this, and we have been successfully integrated. We used to act more like a private equity, or like Visma, like a buyer that keeps a lot of companies doing their own services and companies. So now we are trying. So we are trying to be in the middle ground between a private equity or a strategic, because most of the strategic they acquire, and then the day after the acquisition they put all the guys on board, change the brand, change the office, the everything, and of course arises the challenges of the cultural challenges in this approach. So we are discussing that there is not right or wrong, and this is the approach that we are trying to have now.
Thank you very much, Bruno. We actually do celebrate all the time. So for us, the closing is a very important moment to celebrate, actually. Sindre, let us know how you integrate new teams.
And celebrate, you mean?
No, just how you integrate them. I mean, you can celebrate that in turn.
I'll tell you, when you do that amount of deals per annum, we've stopped sort of popping the champagne. That we don't do anymore. But we do celebrate with at least a good mug of black coffee. So we try to do a little bit of celebration at least. Look, I think couple of key things, right? I think I already started to talk a little bit earlier on about 70% of all founders that we have acquired, they're actually still on board 5 years after, which I think, to be honest, in sort of this world, it's a metric that we're extremely proud of, and it's almost on the edge of being unheard of. Because these founders, I mean, this is what they do, right? And quite often they're off for something else, or things didn't actually turn out the way they wanted or whatever, and then they're off, right? They are a species by themselves, in good and bad. But I think we have a bit of a different approach to the whole integration. First and foremost, we don't actually call it integration, because integration might sound a bit hard. And that's actually not what we're doing. We call it onboarding. And that is closer in resemblance to actually what we're doing to these companies. So we're onboarding them into the Visma Group. And we are always super transparent with them during the DD process about how this 1 + 1 will become way more than 2 and 3 and 4 and 5, and how we're going to create value together. I think that is sort of that transparency is very important. So that, as you said, Bruno, right, there are no fuss around the company name after 100 days or a year or two. I think sort of putting that plan up together, I think that is very key. And then I think our approach to due diligence as well is, it's not unique, not in any way, but I think we look at the DD process as much about, okay, how are we going to go? Because whenever we enter a DD, deal certainty is very high, right? We don't have time, sellers shouldn't have time to actually just do a DD and then we're off. So deal certainty is usually extremely high. And that implies that we've done a lot of outside-in work already. So for us as well, it's as much about thinking about the future. How will this creature look together with us? And then really think about particularly the commercial aspects, but as much it might around the tech, right, product, etc. And to have sort of the right people in the room, and then we work with the companies post-acquisitions through the board of directors. And I do appreciate that sort of a board of directors have a bit of different authorities in different countries and jurisdictions. But typically, that's how we run our companies. So we put in a board of directors that is usually only Visma employees. But I think a very, very important nuance to that equation is actually that this board of directors is only made up by knowledge and not by rank. So whatever we deem as super necessary for this company to focus on, and again, focus is key, right? It's 1, 2, 3 items. It's not 10. Like then nothing will happen. You need to have a small handful of key items. This is what we're going to prioritize. And then you build a board based on that. And what I believe is pretty unique in our group, of course, is that we have tons of founders that have actually done the exact same journey as your company is on. So to have those type of people on your board to help you grow your business, or if it's a pricing packaging thing or whatever, it can be security if sort of the product is not or needs to focus on that. So there are many aspects that we can sort of tackle post signing or closing. So I think that is a bit unique in its approach. But I think sort of looking at sort of founder retentions and how people are actually, because we are measuring all these companies as well on a cohort basis, and they are increasing by 8 points on the rule of 40 after only 1 year. So that says a lot. And I don't think necessarily it's one single thing that makes that massive improvements in both profitability and growth. I think it's, to be honest, I think it's a sum of parts. I think there are many small things that actually starts to become big numbers when you add them all together. And I think also just triggering the entrepreneurs in terms of looking into the ecosystem with like-minded entrepreneurs, like-minded companies, actually starting to look at their KPIs and said, what the heck? Like, what are these guys doing that I'm not able to do? Why do these have these type of retention metrics? And I'm actually doing the same thing, but I have way worse. So to sort of trigger that competitiveness among the entrepreneurs, I think that shouldn't be underestimated either. Realize that was a very long answer on a short question, but hopefully I tried to summarize it a bit.
Thank you very much, Sindre. Alberto.
So we proud ourselves as well of actually keeping talent. Okay, we have all emphasized throughout this call the relevance of the teams. Okay, so from that perspective, okay, is not only founders but the senior management of the companies acquired. Okay, and that's something that we pay particular attention, and we are quite flexible of actually incorporating, okay, if should there be potentially valuation gaps, okay, just to bridge those valuation gaps with actual performance on earn-out tab mechanisms or two-step type transactions in which you actually buy control, and on the second step you're prepared to provide the proper number one, you're providing the incentives for the management team to keep on operating at the very least at the same level that they were operating, if not better even. So that's the one thing that when it goes from, let's say, the analysis of the deal to the actual onboarding of the company and actually working together with the acquired asset as a team. Okay, it's how those performance incentives actually get tracked on a monthly or quarterly basis. Okay, so that at the end, so if we actually identify that the company is below the initial projections, the business plan, etc., we all work together, because at the end of the day, the incentive mechanism should work that if the company does much better, okay, we at Evertech, we all do better. Okay, so that's one principle on actually going from, let's say, even valuation to integration. Okay, the second thing is, as Sindre highlighted, okay, the importance of involving all the areas, the business areas, the support areas in diligence. So that at the end of the day, when we actually have the reports of all the different opportunities that we're analyzing, we already understand what are the, let's say, priority areas for integration. Okay, if there's issues about cybersecurity, issues about compliance, issues about product opportunities to provide features, okay, or build on features for the targeted company product portfolio, okay, so that at least once we get into, we do have this 100-day integration process, okay, or integration onboarding process, we do have it, okay. Of course, you do have a number of things that actually exceed those initial 100 days. But the importance of those 100 days is to connect people. So at the end of the day, like support areas of the acquired companies have a person that they know by face, okay, that they have already met physically, so that they have, and you already start building those bridges so that people feel that they are at home, okay, within the Evertech organization, that as any other organization that operates in different geographies and countries can be complex, and certainly more complex than usually the companies you acquire. So actually try to ease that, okay, going from a small individual entity, okay, operating in certain countries to a big corporation, okay, I think you need to bridge that so that actually the jump is not that high, okay. We do have a founders council, okay, that actually meets with the CEO directly, with no other executive, okay, with no other executive present, so that actually the founders or the two key individuals at the different purchase companies, okay, they can actually, with no filters whatsoever, discuss that on a, let's say, quarterly or a half-year basis with the CEO, okay. and actually that has proven to be a very good place in which good ideas come up, and actually founders feel that it's certainly the right place to even think about what the acquired companies can actually start doing differently, or particularly what other avenues of growth those companies can have within Evertech. Okay, because again, like we have other clients that the targeted companies do not have. We have other technologies, products, or technology can be complementary. So actually, we want the companies to exceed their projections, exceed their business plan. We believe that through the Evertech network, what we are doing at the end of the day is we are allowing founders to de-risk their business plan. Okay, we believe that with our help, they should be more successful, okay, and they should have a higher level of confidence on delivering their business plan, okay? And last but not least, okay, tracking performance, okay, as Sindre has said, okay, we not necessarily implying that I certainly know the day-to-day at Visma, okay, but it seems that maybe at Evertech we do have different verticals, so certain KPIs can be comparable across companies, okay, but when you go from, let's say, managed service provider to payments, okay, the KPIs might not necessarily be the same, but certainly try to provide the founders and senior management comfort, okay, that other management teams that we have on board have faced similar problems, and we're quite open on how those ideas can cross-pollinate between targeted companies.
Excellent. Well, thank you very much, gentlemen, for your time and for your insight and input. I really enjoyed it. So we have now reached our end of this panel. Thank you very much again for joining us, and to the audience, thank you for your attention.
Thank you very much.
Thank you, Jabber, Sindre, Bruno. Pleasure to have this conversation together.
Yes. Thank you all. Great discussions.
Bye-bye.
Bye-bye. Thank you.
To our audience, we appreciate your participation today. Visit WFS.com for more information on events coming up. If you'd like to get in touch with the WFS team, speakers, or the Quorum Group, email us at info@wfs.com.
World Financial Symposiums, the education centre for tech leaders.